Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books, and I've been covering Disney pretty closely these last few months. Bob Iger recently returned to Disney after getting Bob Chapek thrown out of the company. He's the CEO now, Bob Iger. Nelson Peltz is an investor who's been in touch with Disney and letting them know, basically, he knows how to invest in companies and help turn them around. But for whatever reason, they will not give any respect to Nelson Peltz. He is a self-made billionaire. He is a successful guy. He has turned around other companies that he's invested in. He's not asking for a fee. He's not even asking for control of all the company. He's just going and saying, hey, look, I'd like to be on the board of directors so I can help you guys make strategic decisions and also probably introduce you to some other contacts and ideas that you otherwise wouldn't be familiar with. Iger hates the idea. The board of directors completely turned him down, which is unusual because at least they could have said they're going to consider his suggestion, but they shut him down completely. But he's not done. He's waging what's called a proxy fight. Now, first, let's talk about what the board of directors means for a company. I like to go over definitions. What's the role of a board of directors? Chosen by shareholders. The primary job of a public company's board of directors is to look out for the shareholders' interests, because the people that own the stock in the company are the individual shareholders. Managers might own some of the stock. The board of directors sometimes own some of the stock. The board of directors are really there to represent you like an attorney represents a client. In fact, directors are legally required to put shareholders' interests ahead of their own. The board plays a supervisory role overseeing corporate activities and assessing performance of the company and its managers and its strategy. Someone actually has to look beyond just the managers trying to figure out what the strategy for the company should be, because they're supposed to really help keep it honest, basically. So it does make you wonder, what exactly about this guy Nelson Peltz does the board think is bad for shareholders? That said, he is an outsider, and a lot of times corporate boards and managers don't like people looking at their financials in really close ways, because of course there's all sorts of secret information that happens between board members. There's all sorts of conversations that happen between board members, particularly things that they don't really want to discuss because they're a bit embarrassed about potential problems. However, it's really no excuse. They should be letting him join the board. He already invested $900 million in Disney stock. That's a lot of money in Disney stock. Now, yesterday I did a video called Panic at Disney, Billionaire Investor Trying to Get Control of Disney. There will be a proxy fight. So there will be a proxy fight. This video basically is going to go over the 35-page plan discussing what Nelson Peltz's investment company says they could do for Disney and why they think it's important to be done for Disney. I'm going to give you a link to this so you can have it as well. All of this content is available free on restorethemagic.com. That's a website set up by Nelson Peltz and his finance company. Here's what a proxy fight is. A proxy battle is where shareholders get together with other shareholders and use their votes, because stockholders get votes. They get to vote on what happens with the company, to pressure managers of the company and the board of directors to make changes within the company that the managers and the board of directors were not making. The shareholders typically pressure the board of directors by voting against them at the annual general meeting. Disney's annual general meeting is coming up sometime in March this year, so really not far away. The date hasn't been announced yet, but when it comes up, Nelson Peltz is going to be having a proxy vote or a proxy fight for him to be added to their board of directors over at Disney. Okay, so let's get into Nelson's plan for Trian Partners to help Disney restore its magic. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give it a thumbs up. I really appreciate you guys. The channel's growing, and we love talking about this finance stuff every now and then because it's really, really interesting. Why is Trian here today? Disney is the most advantaged consumer entertainment company in the world. It has unrivaled global scale, irreplaceable brands, inimitable parks, and can leverage the Disney flywheel, that's an important word, flywheel, to monetize, make money from, its intellectual property. For these reasons, we believe the company is well positioned to succeed. However, Disney's recent share price and operating performance have been disappointing. Total shareholder return, which is year-over-year share price, which obviously you want it to go up every year if possible, has materially underperformed Standard & Poor's 500 and proxy peers over a 1-year, 3-year, 5-year, and 10-year period. What is the Standard & Poor's 500? The Standard & Poor's 500, or simply the S&P 500, is a stock market index tracking the stock performance of 500 large companies listed on the stock exchanges in the United States. It's one of the most commonly followed equity indices. So the S&P 500 is a common collection of well-known, established, iconic companies. And if you invest in a group of those companies and you look at what the percentage is of improvement over time, That's a good benchmark to say like, well, all right, is your company doing better than them? Is it doing worse than them? If better, why? If worse, why? It's a comparison. Disney shares are currently trading at an 8-year low. Operating performance has deteriorated, including a 50% decline in adjusted price per share since fiscal year 2018. Basically, a 50% price decline in price per share. We believe that the current investor sentiment on Disney is low, reflecting the hard truth that Disney is a company in crisis and faces many challenges that weigh on the company's investment prospect. While we acknowledge that Disney, like many media companies, is undergoing a challenging pivot to streaming, we believe that many of the company's current problems are self-inflicted and need to be addressed. Trian believes that it's well positioned to facilitate positive change at Disney, given our experience investing in and serving on the board of directors of blue chip companies. Blue chip companies are like these S&P 500 companies. They are big established companies. You know the names of the companies they've been on, and we'll reference a few in a bit. And working collaboratively with management teams and boards to optimize corporate governance, strategy, operations, and capital allocation. Basically all the plans that the business makes for what is good for the shareholders, what's good for the business, what's good for the brands. We recognize that Disney is undergoing a lot of change quickly and are not trying to create additional instability by replacing Bob Iger. We believe Disney is at a crossroads. Everyone knows Bob Iger probably should go. Disney is in such a mess right now that were they to try and say, we think we need to get rid of Bob Iger, there is no way that they would get approved to the board. So Bob Iger isn't good. They need to plan him getting the heck out of there, but fine, Bob Iger's there. Let's just get on the board of directors and make Bob Iger start to answer for things and answer some difficult questions. We believe Disney is at a crossroads. It can decide to fight the addition of one qualified board member, Nelson Peltz, or work together with Trian, his investment company, to create sustainable long-term value at Disney. You think about it, like, why would you fight this guy, Nelson Peltz? It still doesn't really make any good sense, except that Disney doesn't want to face reality on a lot of things. For example, their terrible Fox purchase, $71 billion. They may have thought they had to do it at the time. I might have done the same thing if someone asked me, should we buy Fox? It has not worked out well. They need to admit that publicly and deal with the ramifications. There are a lot of business ramifications. Disney stock is trading at an 8-year low. Disney's 10-year share price performance is shown on this chart. Trian overview. So this is Nelson Peltz Investment Company. Investment management firm founded November 2005. Focused on buying large positions in high-quality companies where we see significant long-term potential and working collaboratively with management and boards to optimize strategy, operations, and value creation. Simple goal of ensuring that companies function with a strong ownership mentality. So what's a strong ownership mentality? That is looking at as if you're spending $1 of the company's money. It's not just company money. It's like it's your money. You need to think about how you're going to really do things that are going to be good for the shareholders, not just spend the money like you work there. Spend the money like you own the company. Trian encourages management teams and boards to operate as if it was wearing bifocals, with a watchful eye on the near term, but always maintaining a primary focus on maximizing long-term value. Trian's founding partners have substantially operating and financial experience, serving on numerous corporate boards, as well as serving as C-suite executives of various publicly traded companies prior to the founding of Trian. What is a C-suite executive? That is an executive at a company where they have a C in their title. Chief Executive Officer, Chief Operating Officer, Chief Financial Officer. CCC always has to start with a C, and it means chief because that's the top. These are companies they've worked at. Mondelez, Unilever, Family Dollar, Heinz, Cadbury, PepsiCo. It's DuPont. These are multi-billion-dollar, very large, significant companies. They have experience. There's no question about that. What differentiates Trian? A highly engaged shareholder. Investors with an ownership mentality with a goal to build better businesses for the long term. Unique capital base. Unlike typical hedge funds, and they are a hedge fund, with 90-day liquidity, 85% of Trian's capital is committed for 3 or more years, which is to say almost all of their money is tied up with Trian. They're not looking to buy and sell Disney stock very quickly. They're there for the long term. Average investing holding period of approximately 6 years when a Trian partner joins a board, which is longer than the holding period of the 20 largest Morningstar equity mutual fund classes. Another company, Morningstar equity mutual funds, will buy into a company, they'll hold the company, but Trian's saying they hold it for even longer, so they're not looking to just come in and go out of the company. Having been in the CEO seat, we appreciate that the change does not happen overnight. Focused on driving long-term operational improvements and optimizing strategy by leveraging founding partners' decades of experience running and overseeing businesses. Income statement orientation with a track record investing in growth, including research and development and marketing and driving earnings improvement. Strong preference is always to work with management. Trian has been invited to join a number of corporate boards since inception. Trian partners have served on 17 company boards since 2005. That is relatively a lot. We pride ourselves on not being dogmatic. A core Trian principle is to be a good listener, to consider both sides of an issue, and to support the best ideas regardless of where they originate. Which is to say, we're not going to take full control of your company and tell you what to do, but we're not going to let you just do whatever it is that you want to do. That is something Bob Iger is not happy about. Former CEOs and directors who serve as references, several have worked with us as Trian advisory partners or have served at our recommendation on boards where we have positions. Long track record of value creation with Nelson on the board. Trian has worked closely with numerous companies across industry and has demonstrated a track record of long-term value creation with multiple turnarounds. Trian Investments, where Nelson Peltz served on the board. Company TSR, remember that is the share price of the company, total return of share over year, versus Standard & Poor's during board tenure is approximately 900 basis points, which is 9%, which is a good annual return. Most importantly, we seek to help companies we invest in achieve value creation through improved operating and financial performance, increasing investments to drive top-line growth and market share performance, reducing costs and overhead in areas that impede the company to compete efficiently, optimizing capital allocation decisions to improve return on invested capital. Capital allocation decisions can include things from like how you want to buy a company or sell part of your company, but it could also include things like your financing sources and how are you planning your financing needs over the next several years. The Procter Gamble Company case study. Procter Gamble is a 185-year-old global consumer products company with a portfolio of iconic brands and leading scale and market share across categories. However, Procter Gamble had underperformed over an extended period of time. Total shareholder return underperformed both its peers and the S&P 500 Total Return Index in the previous decade. Lost market share across categories and geographies, flat earnings, and flat earnings per share growth. Trian believed that P&G was struggling to adapt to a changing industry and also needed to address the following factors to fix its underperformance. It had market share erosion and low organic sales growth. Organic sales growth is people are interested in your product, they're telling other people about it, so it just starts to do better and better over time. Dismantle the matrix structure, increase accountability, reduce bureaucracy and excessive costs. The matrix structure in a business is not like Keanu Reeves exactly. Matrix structure means that you have kind of multiple layers of management and a lot of people talking to each other with decision making, which is great for engagement, like getting a lot of everyone's ideas, but it's not necessarily cost effective, and it also slows down decisions. It adds extra layers to the company. Inability to leverage scale in existing organizational structure, aging brands and lack of a breakthrough innovation, insular culture that rejected external perspectives and ideas. So they just wanted inside ideas. That's Bob Iger. In July 2017, Trian nominated Nelson Peltz for election to the P&G board. They didn't want him. In December 2017, after a contested proxy contest, which is coming up with Disney, same kind of situation, where Trian received the support of leading proxy advisory services, ISS and Glass Lewis, P&G announced that Nelson Peltz would be appointed to its board. Getting the support of these proxy services is basically just getting a public recommendation from important people that, yeah, you should be on the board. And when the vote is done, the vote is done. Whoever wins the vote wins. He's either on it or he's not. P&G case study, Procter Gamble overhauled its matrix structure. Okay, so we discussed this matrix structure. This is basically the idea that instead of having multiple complicated layers, you cut out a lot of the layers, it saves costs, and it speeds innovation at the company because you don't have to wait for decisions to be made nearly as long. Simplification dramatically improved performance. So as a result of the simplifying of the matrix structure, significant improvement in financial performance, increased organizational accountability and agility. And why accountability? Accountability is if you have 10 to 15 people involved in every decision, whose fault is it when something goes wrong? Whose idea is it when something goes right? Who deserves the credit? The less people involved, the better. The people that are really relevant to the decision making, much better. Keep it small. Market share losses to market share gains, so they gain market share. Improved product superiority and overall brand health. So their sales went up, their growth went up. Trian's been developing strong relationships with company boards and management teams following prior proxy contests. So they had a proxy contest with Heinz, with DuPont, and P&G. And with those three, all three of them, they didn't want him on the board. After they got involved and they got on the board, they then wrote glowing things about him, basically saying, you know what, this guy really doesn't get in the way. as much as it's scary to have somebody else come in, he's not that bad. He actually gave us good suggestions and he's very productive. So now he's friends with them. Maybe the same thing will happen with Disney. Disney's total shareholder return consistently underperforms. And this is a chart just showing Disney's stock is not doing well. I mean, it's not been doing well. Disney's financial performance has been disappointing. So this is a chart of their adjusted revenue from 2018 to 2022. And it shows that, yes, they got some revenue increases because of the 21st Century Fox deal, but they lost a lot of their profitability when they did that. And now, what do they have from Fox that's so valuable? Fiscal year 2023 guidance raises serious questions. Can management forecast appropriately? Does Disney have the ability to effectively manage its business? And also, why didn't Disney's CFO issue a warning beforehand? So this question of a warning is a great point. To my memory, I don't think I've seen anyone else talk about this. Peltz is bringing up here, hey, normally when you have a quarter and it's going to be a bad quarter and it's less than what analysts are publishing, because analysts analyze the company, they're paid to analyze the company. They say, okay, we're expecting Disney to have this such and such results. Well, in their last quarter, their results were horrific. They were terrible. And it was well below what people thought it was going to be. The CFO's job, in part, is to communicate with those analysts in advance and just say, hey, don't freak out, but in a couple of weeks, we're going to be announcing numbers. They are going to be substantially less than what you have us at. We can't tell you what they are, but they start to put the word out so people don't absolutely freak like they did when Bob Chapek and Christine McCarthy in the earnings call just announced, hey, we have horrendous results. Disney has underperformed under this board's watch. While Bob Iger just rejoined the board, he has essentially served on the board since 2000 with only a short respite from January through October 2022. There are still several current directors and members of management who oversaw and approved some of Disney's worst corporate governance and strategic decisions, including overpaying for the Fox acquisition, the expanding streaming losses, and over-the-top compensation packages granted to Bob Iger. The people that were on the board that approved the Fox decision, even if that seemed, 22 years, Bob Iger approximately on the board, there are people that are on the board now that were there when they made a lot of stupid moves or moves that seemed brilliant at the time but didn't work out. Well, you should leave because you didn't have the idea and the vision to question it. I mean, even if it's no one's fault, they shouldn't be still on the board, not the same people that made bad decisions. A strong case for change at Disney. Capital allocation, how they spend their money and make decisions about investing in things, how they make decisions about are they going to buy another company. Since 2018, earnings per share has been cut in half despite $162 billion spent on mergers and acquisitions and other investments. The idea is if you're going to spend a ton of money, okay, but we should be earning more money per share and it should generate more profit, not less profit. It's that simple. Or shareholder engagement. So as a shareholder, if you contact them and you want information from them, even if you own $1 billion worth of stock, they're not going to give you the kind of feedback and information that you need. Disney's board and leadership consistently failed on succession planning. Well, there's no way to even argue the fact that Bob Iger was terrible at succession planning. Over-the-top compensation packages. Bob Iger made way too much money working at Disney. And I think they go into some specifics on numbers, but it certainly wasn't tied to performance. Corporate strategy and operations. A flawed direct-to-consumer strategy struggling with profitability despite reaching similar revenues as Netflix and having significant intellectual property advantages over Netflix. Because, it's not like Netflix owns Star Wars. And what if Netflix owned Star Wars? What if Netflix owned the Disney brands and owned Marvel? What would they be doing with it versus what Disney's doing with it? A lack of overall cost discipline. They spend money as if it's company money, not the shareholders' money. Over-earning in the parks business to subsidize streaming losses. There are many complaints about Disney overcharging at the theme parks. A lot of unhappy customers. They're taking the brand loyalty they build up in the theme parks and they're burning through it like a credit card. And eventually it's gonna, like credit cards, hit its limit and be worthless, and they're going to be a terrible situation. Disney's mergers and acquisition growth and investments have been earnings dilutive. While Disney's growth, investments, and mergers and acquisitions have contributed to total revenue growth of 41% between fiscal year 2018 and 2022, earnings has declined 50% per share over the same period. So we just talked about this. Even though their revenues have gone up because they've spent all this money acquiring Fox, investing in content for streaming and other investments, they're making less money for the stockholders. That's a big problem. Disney wildly overpaid for the Fox assets. Disney appears to have paid 26.5 times 2018 profit, basically, EBITDA, for Fox's traditional media assets, excluding Hulu, whereas comparable media transactions were completed at 11.9 times EBITDA, basically cash flow. The Fox deal created a massive incremental goodwill balance of $50 billion. So by overpaying by $50 billion worth of what was on the books for the true value of assets minus liabilities of Fox, by overpaying so much, it destroyed their balance sheet. It means they owe all of this money, and how are they going to actually eventually pay it back? They're going to pay it back, but they're going to pay it back at the expense of the theme parks, at the expense of what could be done with other business opportunities, with Star Wars, with all the Marvel properties. Disney's had to rely on an ultra-aggressive $2 billion synergy assumption, which would imply a doubling of Fox's EBITDA to justify the deal. So they had to rely on, we're going to acquire Fox, but don't worry because we're going to lay off so many people and we're going to have so much savings that it's going to just basically pay for the whole thing. While difficult to quantify, we believe that Fox's earnings power has deteriorated post-deal, implying an even higher multiple paid than the 26.5% paid at the closing. So basically they're saying that the Fox company that they acquired for $71 billion is worth less today than when they acquired it for $71 billion. And not just worth less in that it was never worth as much as they paid for it, worth less in that it actually has less earning power overall because the business hasn't been managed well by Disney. The Fox acquisition has not delivered promised financial benefits. Disney's 2022 operating profit, excluding parks, experiences, and products, of $3.1 billion is 74% below the pro forma operating profit of $11.8 billion at the time of the acquisition in 2018. Even excluding the streaming losses, Disney's parks, experience, and products operating profit appear to be $6 billion lower today than the pro forma operating profit at the time of the acquisition. This begs the question, is there a large Fox write-down on the horizon? And the answer to that is there better be, and there's going to be, because he'll sue them if they don't do it. And the Fox write-down is basically to say, listen, you paid $71 billion. We all know it's probably worth closer to $35 billion. You're going to have to admit that you overpaid by 30, maybe $25 billion. Take it off your books and say, oops, we have an extraordinary loss. That's what companies do. So then they'll say, okay, well, don't judge us, but we have a $25 billion loss because we have to account for the fact that Fox is not worth nearly what we paid for it. That is going to be very bad for the stock, but they do need to just get it over with. Fox acquisition increased Disney's leverage dramatically. Investors are still paying for the Fox deal as Disney works to reduce its leverage. Disney is also expected to buy Comcast's $9 billion stake in Hulu in 2024, which will keep its leverage profile well above historical levels for years. Okay, so the leverage profile is to say that they're going to have to borrow more money to pay for it, or if they aren't going to have to borrow more money, they're not going to be able to pay down debt that they otherwise could have paid. So they're going to owe more money. An acquisition of Sky by Disney would have permanently impaired shareholder value. So Disney was looking to buy Sky, which is a broadcaster out of the UK. The deal didn't go through, and basically Peltz is saying here, thank God it didn't go through, because if it did, what you guys were offering to pay is well in excess of what it's proven that Sky was worth. There's just more examples of the people on your board who said, let's buy Fox, let's buy Sky, let's spend unlimited amounts of money on streaming and not keep track of it. Those people should not be on the board anymore, at least some of them. Earnings and free cash flow are not expected to recover to 2018 levels for at least another 3 years. Disney's adjusted earnings per share. So it's going to take 3 years till 2026 until Disney at its current path is going to get back to where it was in 2018. That doesn't sound so good. That's if everything works right. We believe that Disney no longer values free cash flow, and that needs to change. Disney had a history of increasing its dividend. In 2020, Disney eliminated its dividend as it faced cash flow challenges caused by the COVID-19 pandemic, significant streaming investments, and its over-leveraged balance sheet. Prior to 2020, Disney had paid a dividend for 57 straight years, with emphasis placed on growing the dividend. Disney has not provided a timetable for restoring the dividend beyond achieving pre-Fox leverage levels, which could take years. The dividend is how much money they were paying in cash, basically shared profits to shareholders for every stock that somebody owned. So you had one share in the year 2019, you get $1.76. In 2020, you get 88 cents, and ever since you get nothing. Disney's shareholder engagement process, or lack thereof, is indicative of poor governance. So the board did invite Nelson Peltz to meet in person 3 years ago to hear his views on Disney, and barely gave him the same opportunity 3 years later again. Now, why would they have let him in 3 years ago, in September 2019? Because he's an investor. He's got money, And when you've got a company and you're looking for people to help support your stock and purchase your stock and hopefully hold it and say good things about the company, you meet with investors. So they heard him out then. They don't want to listen to him now. But why don't they want to listen to him now? Let me know what you think in the comments below. Why won't they listen to Nelson Peltz? The succession process is broken. Well, there is no question the succession process is broken. The fact that Bob Chapek was abruptly fired 5 months after the board unanimously agreed to extend his contract by 3 years suggests that the board lacks a robust CEO succession process and completely misread the state of Disney and Bob Chapek's performance. You can't argue with that. You just can't argue with it. He's right. And the succession issue, look, it's important because someone has to be the CEO of this multi-billion-dollar company. You can't just say like, well, we'll pick this guy. Now let's pick the other guy. No, you have to have a process that shows that what your plans for the company are, that this person at this time is the appropriate leader. Disney doesn't have a process like that. It just kind of lets Bob Iger poke and point and just do whatever he wants to do. Put this guy in, take this guy out. I'll come back, but only for 2 years. This is affecting millions of people that own the Disney stock. Even more puzzling, if streaming was to be Disney's central focus, why was Bob Chapek ever made CEO to begin with? The initial decision itself appears flawed given Bob Chapek's lack of experience on the media side of the business, which led to Bob Iger being appointed as executive chairman and head of creative endeavors, preventing Bob Chapek from establishing himself as the clear leader of the organization. And a lot of people have talked about this, Bob Iger interfering and blocking Bob Chapek from doing what he needed to do with the company. This is the result, a big old mess. CEO succession has been a long time issue for Disney's board. It has been, ever since going back to Michael Eisner. There were issues with how could you replace the CEO. They replaced Michael Eisner. Michael Eisner brought someone on, and then he pulled someone off. It was a mess when Michael Eisner left. And Eisner never wanted Iger. And similarly, going back to now Iger's tenure, October 2011, Bob Iger signs contract extension where he remains chairman and CEO through March 2015. He'll serve as executive chairman through June 2016. Then there's another contract and he leaves and now he's back. Why is this necessary? Disney is a complicated company. It's not that complicated. They need a process for how they're going to select their strategy and their CEO. And it's the weakness of the board where they can't come together with like, look, this is what we know our strategy should be. Disney is unique in the properties that it owns, in the formats that it owns. The theme parks is very unique. It's international distribution, it's international theme parks, the TV shows, the streaming, the films. With Fox, they had such a commanding percentage of market share of film. They even have Avatar now. They have a lot, but because they have a lot, they need to organize it into a unique strategic plan. And then they need a CEO that can clearly step in and execute on that plan. Executive compensation must be aligned with performance. From fiscal year 2017 to 2021, Bob Iger received $216 million in total compensation, despite Disney's poor shareholder return year after year on the value of the share. Iger's compensation would have been even higher if shareholders had not voted against the pay package that he received in December 2017 as a reward for the Fox deal. The board agreed to reduce his compensation in order to increase its say on pay vote and appease shareholders. Iger was set to earn up to an estimated $423 million over 4 years in the original pay package that the board was voted down by shareholders to say, no, we are not paying Bob Iger that much money. Disney's streaming strategy, ready, fire, aim. We're concerned with how Disney's streaming strategy has evolved under the board's oversight. While we believe Disney Plus started as a niche, direct-to-consumer extension of Disney's franchise flywheel, it has rapidly, and that is true, it was supposed to take its brands, put them through the streaming service, have unique content for those really powerful brands, and then use the presence on the streaming service to drive interest in their licensing, in their theatrical projects. But being that they can't really release Star Wars movies because they just don't know how, and the Marvel movies are losing their potency, everything is just really a confused mess at Disney Plus. And this is an interesting reference. He talks about the flywheel. This is where he's basically implying the woke content has to go. You've got to have compelling content that when you get people's interest in that content, it will extend to licensing, theme parks, people wanting to re-experience and experience again that same brand and create excitement and enthusiasm for the company. That's the flywheel for the intellectual property. Nelson Peltz's people don't miss that. In his world, in his language, they're not going to say woke Disney this, woke Disney that. Daily Mail will say war on woke, billionaire investor Nelson Peltz attacks Disney, wants board seat, he's going to attack woke Disney. They're not going to talk about woke Disney in some official document like this where they're dealing with investors, but they will say that the franchise flywheel needs to be fixed. Means the same thing. So while we believe in Disney Plus started as a niche direct-to-consumer extension of Disney's franchise flywheel, it has rapidly shifted into the core distribution channel for the majority of Disney's intellectual property, leading Disney to significantly ramp up investment to drive new subscriber growth at all costs. However, in our view, management failed to effectively communicate the financial rationale behind the strategic pivot, as the profitability guidance has not changed, while the change in strategy puts significant stress on Disney's balance sheet and cash flow profile. Disney has lost $11 billion in streaming to date, with more losses coming. Disney is saying they think they're going to break even in 2024 on streaming. So they're going to lose more and more hundreds of millions of dollars at least until they break even, but it's $11 billion so far. Disney does not leverage its substantial scale in streaming. Disney is guiding direct-to-consumer operating profit break even in 2024 when the market expects the business to generate $29 billion of revenue. We're surprised to see that Disney's best-in-class intellectual property franchises and scale, because they can scale, meaning they can do a lot of volume, have not led to inline, if not superior, unit economics compared with Netflix, which generally lacks high-quality franchise intellectual property. So what they're saying here is, hey, wait a minute. If you own Marvel, you own Pixar, you own Star Wars, you own more stuff, why can't you profitably exploit your brands on your proprietary platform? Why is it that Netflix is more profitable on its IP than you are when your IP is so much more valuable? Disney's current streaming strategy is leading to inefficiency. So Netflix spends more money on programming and production costs than Disney. They generate more revenue than Disney. Netflix spends 30% less on other expenses than Disney does. And Netflix earnings before interest and taxes margins are 40% higher than Disney. So the profit margins are much higher at Netflix. Nelson wants to know is why. We believe Disney lacks cost discipline as an organization. Basically, they just show they don't really care what their operating costs are over at Disney. They just keep floating along. We fear Disney is over-earning in domestic parks to subsidize streaming losses. We talked about this. They're charging way too much for theme park amenities, and they're paying their people not enough. Disney may believe that price increases and nickeling and diming of cast members and other costs is good for the bottom line. However, we suspect it is short-term thinking that puts the brand value and long-term health of the business at risk, which of course they do. And there are numerous testimonials of companies that have worked with Nelson Peltz and his investment company and have basically proven that even though they might not have liked him going in, by the time they got to work with him, they saw he can generate results. Well, let me know what you think of all this in the comments below. Do you think Nelson Peltz has a point? Do you think he's going in the right direction? Do you think he'll have success getting some change at Disney? Let's not forget, even though it's very difficult to do, Elon Musk was pretty successful with Twitter. He had to risk a lot of money, and he was forced into doing it. But Peltz has done this with other major multi-billion-dollar companies. So there's really no reason he shouldn't be able to have an effect on Disney, especially because Disney, it's clear they're not doing well. Wall Street thinks they're not doing well. Creatively, people are losing interest in Disney. The only people that seem to be happy with Disney are the people that love to control it to put all of their woke messaging in all of their content. Other than that, no one else is really thrilled with Disney these days. So let me know what you think in the comments below. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.